go ahead to other slides. I have divided the entire thing on the topic-wise allocation and discussed it based on the subject that is considered in the amendments. So first, I would go to the cash economy which we were having, and the government is trying very hard to make the economy a digital one and non-cash economy. Right from the days when demonetization took place, government has taken a number of steps to avoid or to discourage the cash transactions. And in continuation of that, they've suggested or they've proposed two changes in the Income Tax Act, whereby whenever there are any cash withdrawals from any bank account during the year which exceeds 50 crore rupees, there would be 2% tax deduction. So, as per the current scenario, those who are having very large turnover, very large transactions, but they are not having income, they are getting scot-free and they are not required to file the return if their income is below taxable limit. This is what many people are doing. So, in order to bring them to the tax net, once the TDS is deducted, they would be required to file, they would be forced to file that income tax return. And with the kind of turnover or kind of cash withdrawal that they have from their bank account, there could be many other possibilities for obtaining the required tax amount from them. So the liability or the responsibility of deducting tax has been given to the companies or the banking companies or the post offices who use these payments, and they are required to actually deduct this tax. So we'll discuss this in detail whenever required. But currently the cash withdrawal limit of 1 crore per annum for all the accounts that you have is the threshold limit, whereby once you exceed the turnover of 1 crore rupees, a cash withdrawal of 1 crore rupees from any bank account, bank would start deducting 2% of taxes. So that is as far as the cash transactions are concerned. Then we go to foreign. Sorry, foreign remittances in certain cases. Currently, the differences between the stamp duty valuation and the price at which the agreements are entered into is taxed as gift under Section 56 of the Income Tax Act, and the liability to pay this tax on the income generated out of gift is on the recipient, that is on payee. So, as and when the agreement takes place between a local person, the resident Indian, and a non-resident Indian, the difference would obviously get taxed in the hands of recipient, that is non-resident Indian. But because the person is not resident in India, gift is not getting taxed in India, because the income does not, definition of income does not support that, because income is not getting accrued or arising in India, and that is why they are getting scot-free. So under the deeming provisions, the changes have been made whereby any difference between the stamp duty valuation and the agreement value would get taxed as the income in India, and at the time of remittance of this money out of India, there would be some withholding tax liability on the person who is remitting the money. Of course, the treaty between the two countries, if this amount is getting tax-free due to treaty, there would not be any tax incidence on these transactions. The next point we go to is on exemptions. There are quite a few exemptions which are provided, which are sought to be provided to us. One of them is on the national pension scheme of the employee, whereby under the existing provisions, exemption of 40% of the total amount of money is available when someone opts out of the scheme. This amount of 40%, this proportion of 40% is sought to be increased to 60%. But mind well, this is available only when the account is getting closed or one is opting out of the pension scheme. So whatever amount that is left in the account at the time of opting out of the scheme, 60% of the amount can be withdrawn, which would become tax-free in the hands of recipient, and the balance amount would remain as taxable. The other exemption which is sought to be given to the taxpayer is on interest paid to a non-resident by a unit in IFSC. International Financial Services Centers, as we all know, are set up all across the countries, and one of the example is Gift City in Ahmedabad. So whenever a unit in IFSC, which is practically considered to be outside the India territory, whenever a unit in IFSC is taking a loan, borrowing money from a non-resident person, the interest which is paid to them would become tax-free in the hands of recipient. But remember, this is available only after 1st of September 2019. And not only payment of interest, but the actual borrowing should have also been taken place after 1st September 2019. Then only this exemption would be available to the recipient of the interest. Next is NBFCs. As we all know, there are a lot of UNQs being made about NBFCs. Number of NBFCs are going bad, and the entire economy is having a turbulence because of NBFCs. So they are at receiving end for quite some time, and government thought it proper to give them some benefits in the form of relaxation of some limits, some conditions about the taxability of NBFCs. Currently, all the payments of interest which we are making to the banking companies or the financial institutions or the state financial corporation and specified housing finance companies are allowable as deduction only if the amount is actually paid to the lender before the due date for filing the return. NBFCs are as such not covered currently in these categories, and hence even if interest is not paid to NBFC, one is able to claim this interest as deduction on accrual basis. Due to this, NBFCs were suffering a lot, and there are a lot of bad debts which are happening, but despite that, NBFCs have to show it as income, and the other person is also getting deduction. So in order to encourage people to make payment of interest so that the allowance of expenditure is available to them, a provision is made whereby interest is brought within the purview of section 43B, whereby the interest would be allowed to a borrower only if it is actually paid to the NBFC. Of course, NBFCs are also bound by certain rules and regulations whereby they will have to classify these as bad debts or bad or doubtful loans, for which the rules are already existing for banking and financial institutions. Those same rules would be applicable to NBFCs also, and they are also given liberty to actually offer tax on these income on receipt basis whenever, as and when the loans are considered as bad or doubtful, they are classified as bad or doubtful in their financial statements. And who are these NBFCs? These are only specified NBFCs. Not all the NBFCs are covered in this. Only deposit taking NBFCs are covered in this. So those NBFCs who are taking money from public, they are given this benefit. And other than that, there is one more category of NBFCs who are given this benefit. And those NBFCs are known as systematically important non-deposit taking NBFCs, having total asset of more than 500 crore rupees. So both these kind of NBFCs, one taking the deposit, other not taking the deposit, but they are having total asset of more than 500 crore rupees. Both these NBFCs would get benefit of this, and to discourage non-payment of interest, the deduction allowable to the borrower is also restricted. As and when they make payment, then only they can claim this as deduction. That is for NBFCs. We go to the startups. As we know, startups are the first love for the economy right now, and everyone wants to have startup. The government is also interested in giving the all kinds of benefit to startups. So last few years we have been seeing, last 4-5 years we have been seeing something or other thing, some or other things are given to startups, and this year is no exception. Startups by its very nature